Your base salary is $180,000. With RSUs, your total compensation is $380,000. You'd probably assume a mortgage lender uses all $380,000 to qualify you. Not necessarily. In fact, if you rely on what AI tells you about qualifying with RSUs, you could end up looking at the wrong price range, or worse, think you can't buy when you actually can. Here's what lenders really look for. To use restricted stock unit RSU income for mortgage qualification, there are typically two major requirements. First, you generally need a 12 to 24-month history of the RSU vesting from a publicly traded company. Second, lenders usually want to see that your vesting schedule is expected to continue for at least 3 more years. But here's the part that surprises most buyers. Lenders don't simply use today's stock price. For conventional loans backed by Fannie Mae and Freddie Mac, the income calculation is typically based on a 200-day moving average of the stock price, which helps smooth out volatility. Now, here's where AI often creates confusion. If you ask Gemini, it may tell you that RSU income is limited to 35% of your total qualified income. That's not a Fannie Mae or a Freddie Mac rule. That 35% limit is a lending overlay used by some banks on certain jumbo or portfolio loans they keep on their own balance sheets. It does not apply to most conventional loans, which make up roughly 70% of the mortgage market. That's why two lenders can look at the exact same compensation package and approve very different loan amounts. If you're in tech and a significant portion of your income comes from RSUs, don't guess and don't rely on generic AI answers. Have a mortgage broker run your numbers across multiple lenders before you start home shopping. If you'd like to understand how financial gurus like Dave Ramsey and Susie Orman feel you should set up your home ownership budget versus what lenders allow, watch my full video, How Much Home Can You Really Afford?